ExamPrep.School. Indiana Life Insurance Exam. There are 4 practice exams in this series. This video covers Practice Exam 1. The first 20 questions are free. In this video, we will be covering the following major categories for Practice Exam 1: completing the application, underwriting, and delivering the policy. Indiana laws and department rules common to all lines. Life provisions, riders, options, and exclusions. Life regulations. Retirement and other insurance concepts. Types of policies. Let's walk through the format. I'll read each question and its choices. Let's get started. Question 1. Which of the following accurately characterizes the difference between level term and decreasing term life insurance policies? A. Level term premiums remain constant while decreasing term premiums decrease in proportion to the declining death benefit. B. Level term death benefits remain constant throughout the term, whereas decreasing term death benefits decline over the policy term. Both typically use level premiums. C. Level term uses decreasing premiums to match reserve growth, whereas decreasing term uses level premiums because of lower risk exposure. D. Level term allocates part of the premium to cash value, whereas decreasing term has no cash value component. A countdown circle appears in the top right. Once it completes, the answer is revealed. You can pause at any time if you'd like longer to think. If you'd like additional practice covering more topics, see the description for our book. The correct answer is B. The correct answer is that level term maintains a constant face amount, while decreasing term reduces the face amount over the term. Both use level premiums throughout. Reason A is not correct. Premiums for decreasing term remain level despite the reduction in face amount, so the statement about decreasing premiums is incorrect. Reason C is not correct. Level term uses level premiums rather than decreasing premiums, and the explanation of risk exposure is misplaced. Reason D is not correct. Term policies generally do not accumulate cash value, so allocating part of the premium to cash value is incorrect. Question 2. Which statement best describes how premiums change in an annual renewable term life policy? A. Premiums increase each renewal period based on the insured's attained age and corresponding mortality costs, without requiring proof of insurability. B. Premiums remain level for an initial period, then escalate in fixed percentage steps at predetermined anniversaries. C. Premiums decrease annually in line with declining mortality risk and reserve accumulation. D. Premiums are refundable each year if no death benefit is paid. The correct answer is A. The correct answer is that annual renewable term premiums rise each year to reflect higher mortality costs at older ages, and no evidence of insurability is required for renewal. Reason B is not correct. Stepped premium increases at longer intervals describe a step rate term, not annual renewable term. Reason C is not correct. Mortality risk increases with age, so premiums do not decrease annually. Reason D is not correct. Annual renewable term does not refund premiums. No claims refunds are not a feature. Question 3. Which provision in a term policy allows renewal without evidence of insurability, and typically up to a specified attained age? A. The renewable term provision guarantees renewal at attained age premiums without proof of insurability, usually up to around age 65. B. The conversion provision allows renewal without underwriting throughout the policy term. C. The waiver of premium provision permits renewal only if the insured remains employed in the same occupation. D. The return of premium provision grants renewal rights, provided no claims have occurred. The correct answer is A. The correct answer is that the renewable term provision guarantees renewal without medical evidence at premiums based on attained age, typically up to a contractual limit such as age 65. Reason B is not correct. The conversion provision allows changing policy type, not renewing without evidence of insurability. Reason C is not correct. Waiver of premium relates to disability, not renewal requirements. Reason D is not correct. Return of premium deals with refunds at term end, not renewal rights. Question 4. Which feature best describes the conversion option in a convertible term life insurance policy? A. The conversion option permits changing to a permanent policy without proof of insurability up to the conversion deadline, often by age 65. B. The conversion option requires proof of insurability when converting to a permanent policy. C. The conversion option allows switching to another term policy form at the same initial rate. D. The conversion option extends the term period by one renewal term without premium change. The correct answer is A. The correct answer is that the conversion option allows the insured to convert to a permanent policy without new underwriting up to the policy's stated conversion deadline, such as age 65. Reason B is not correct. Conversion typically does not require evidence of insurability. Reason C is not correct. Conversion is to permanent policies, not another term policy at the initial rate. Reason D is not correct. Conversion does not extend term coverage without premium change. Question 5. Which condition generally must be met for a return of premium term life policy to refund premiums at term expiration? A. The policy must remain in force without lapse or surrender throughout the terms. B. The insured must convert to a permanent policy at term expiration. C. The policy must accumulate a minimum cash value during the term. D. Premiums must have been paid as a single lump sum at inception. The correct answer is A. The correct answer is that premiums are refunded only if the policy has remained in force for the full term, without lapsing, surrendering, or taking policy loans. Reason B is not correct. Conversion to permanent coverage is optional and not required for the refund. Reason C is not correct. Return of premium policies do not rely on cash value accumulation for refunds. Reason D is not correct. Premiums may be paid annually or monthly. Lump sum payment is not a requirement. Question 6. A 40-year-old executive holds a whole life policy with a term rider that provides additional coverage until age 65. He now needs $500,000 of term coverage, independent of his permanent policy, to secure a business loan without risking his cash value. Which approach best meets his need while minimizing impact on the permanent policy's cash value? A. Increase the term rider amount within the existing whole life policy. B. Purchase a separate standalone 20-year term policy for $500,000. C. Convert the term rider into a standalone term policy. D. Add a renewable term rider to the existing whole life policy. The correct answer is B. Purchasing a separate standalone term policy provides the required independent coverage without encroaching on the whole life policy's cash value and maintains its guarantees. Reason A is not correct. Increasing the rider within the permanent policy still exposes cash value to premium risk and policy changes. Reason C is not correct. Term riders typically cannot be converted into standalone policies and would not isolate coverage. Reason D is not correct. Adding another rider continues to tie coverage to the permanent policy and may alter cash value dynamics. Question 7. A 50-year-old insured's original 20-year level term policy is about to expire. He has maintained excellent health and qualifies for re-entry underwriting to extend coverage. Which premium determination applies under the re-entry provision? A. A lifetime level premium based on his original issue age. B. A new premium based on his current attained age using standard mortality rates. C. A renewal premium equal to the original premium multiplied by a mortality adjustment factor. D. A level premium plus a conversion surcharge for issuing a new term contract. The correct answer is B. Re-entry underwriting resets premium based on the insured's attained age and current mortality tables, reflecting updated risk rather than original issue rates. Reason A is not correct. A lifetime level premium would ignore increased age-related mortality and is not provided under re-entry. Reason C is not correct. Re-entry does not use an adjusted original premium, but recalculates at current rates. Reason D is not correct. No conversion surcharge applies when renewing term via re-entry. It simply resets rates. Question 8. Which mechanism allows an ordinary whole life policy to maintain level premiums throughout the insured's life? A. Decreasing mortality charges offset by dividend adjustments. B. Applying identical loading factors each policy year. C. Charging premiums above mortality cost early to build reserves for later years. D. Recalculating the premium annually based on cash value. The correct answer is C. The correct answer is that ordinary whole life policies front-load premiums charging more than the mortality cost in early years to accumulate reserves that offset higher mortality costs in later years, thereby keeping the premium level over the insured's lifetime. Reason A is not correct. Mortality charges do not decrease over time. Reserves, not dividends, fund later costs. Reason B is not correct. Identical loading factors ignore rising mortality costs and cannot alone level out premiums. Reason D is not correct. Recalculating premiums annually would produce variable, not level, premiums. Question 9. Which pair of assumptions primarily determines the guaranteed cash value accumulation in a traditional whole life insurance policy? A. Mortality table and non-guaranteed dividend scale. B. Insurer's investment performance and dividend elections. C. Asset cash flows and insurer credit spreads. D. Mortality charges and minimum interest rate assumptions. The correct answer is D. The correct answer is that guaranteed cash values are calculated using the insurer's mortality assumptions and the contract's minimum interest rate guarantee, which together define the surrender value growth schedule. Reason A is not correct. Dividend scales are non-guaranteed and excluded from guaranteed cash value calculations. Reason B is not correct. Investment performance and dividends influence non-guaranteed values, not the guaranteed schedule. Reason C is not correct. Asset cash flows and credit spreads affect surplus, not the contract's guaranteed values. Question 10. In a participating whole life insurance policy, dividends are best defined as A. Guaranteed additions credited to the policy's face amount. B. Refunds of the insurer's divisible surplus to policy owners. C. Credits arising from waived policy loan interest. D. Mandatory non-forfeiture benefits payable upon surrender. The correct answer is B. The correct answer is that policy dividends represent a share of the insurer's divisible surplus returned to policy owners. They are not guaranteed but are paid when a surplus exists. Reason A is not correct. Guaranteed additions differ from dividends. They are non-forfeitable benefits specified in the contract. Reason C is not correct. Policy loan interest waivers relate to loans, not to the insurer's surplus distribution. Reason D is not correct. Non-forfeiture benefits are guaranteed minimums, not discretionary surplus distributions. Question 11. Under the accumulation at interest dividend option in a participating whole life policy, dividends are A. Used to purchase additional fully paid up insurance. B. Paid directly to the policy owner in cash upon declaration. C. Applied to reduce future premium payments. D. Retained by the insurer and credited to cash value at a guaranteed interest rate. The correct answer is D. The correct answer is that under the accumulation at interest option, dividends remain on deposit with the insurer, earning interest at the rate guaranteed in the contract, thereby increasing the policy's cash value. Reason A is not correct. Using dividends to buy paid-up additions is a distinct option from accumulating at interest. Reason B is not correct. Cash payments option would pay dividends directly, not accumulation at interest. Reason C is not correct. The reduction of future premiums is a separate dividend option, not accumulation at interest. Question 12. Emily owns a participating whole life policy and receives a dividend check. Concerned about maximizing the policy's death benefit, she selects the paid-up additions dividend option. Which result will most likely occur? A. The death benefit increases immediately and the policy's cash value grows at an accelerated rate. B. The cash value increases gradually while the death benefit remains level until policy maturity. C. Future scheduled premium payments are reduced by the amount of the dividend used for additions. D. Dividends credited to paid-up additions are paid out in cash on an annual basis. The correct answer is A. The paid-up additions option uses dividends to purchase additional paid-up insurance, which immediately boosts both death benefit and cash value and compounds future dividends on a higher base. Reason B is not correct. Using dividends for paid-up additions increases death benefit immediately rather than keeping it level. Reason C is not correct. Paid-up additions option does not reduce scheduled premiums. It adds paid-up insurance instead. Reason D is not correct. Paid-up additions are not paid out in cash, but are added to the policy as additional coverage. Reason D is not correct. Waiving exclusions removes the insurer's ability to rely on policy provisions. A. The next scheduled premium is reduced by the dividend amount, while death benefit and cash value remain unchanged. B. The dividend buys additional paid-up insurance, increasing both death benefit and cash value immediately. C. The dividend is applied toward an outstanding policy loan, reducing the loan balance and potential interest. D. The dividend buys one-year term insurance coverage, equal in amount to the dividend declared by the insurer. The correct answer is A. Applying dividends to premium reduction offsets the next premium on a dollar-for-dollar basis without altering the death benefit or cash value accumulation. Reason B is not correct. Premium reduction option does not purchase paid-up additions. It lowers premium instead. Reason C is not correct. The loan repayment option would apply dividends to a loan, not premium reduction. Reason D is not correct. The one-year term purchase is a term option, not the premium reduction option. Question 14. In a universal life insurance policy, which statement correctly distinguishes between the target premium and the minimum required premium? A. Target premium is the minimum amount needed to prevent policy lapse for the current period. Minimum required premium is a guideline amount recommended to achieve guaranteed assumptions. B. Target premium is the amount needed to cover the cost of insurance only. Minimum required premium funds the expense charges of the insurer. C. Target premium is the illustrative guideline amount to sustain projected guarantees and benefits. Minimum required premium is the absolute amount needed to maintain coverage for the policy period. D. Target premium is an inflexible fixed payment schedule. Minimum required premium is a flexible amount determined by premium loads. The correct answer is C. The target premium serves as a recommended funding level to meet projected assumptions and maintain policy guarantees, while the minimum required premium is the smallest payment needed to keep the policy in force for the current period. Reason A is not correct. This reverses the definitions by treating the minimum required premium as the guideline recommendation. Reason B is not correct. This confuses cost of insurance with expense loading and omits the guideline funding purpose of the target premium. Reason D is not correct. This mischaracterizes both premiums by implying the target premium is fixed and the minimum is variable. Question 15. Which of the following best describes the cost of insurance deduction in a universal life insurance policy? A. It's a monthly deduction equal to the present value of future death benefits minus accumulated cash value. B. It is a one-time charge applied at policy issue to cover initial administrative costs. C. It represents the insurer's expense load and is assessed as a percentage of premium paid. D. It is the mortality charge calculated as the product of the cost of insurance rate and the net amount at risk for each policy period. The correct answer is D. The cost of insurance deduction is the periodic mortality charge computed by multiplying the cost of insurance rate by the net amount at risk, reflecting the insurer's mortality cost for that period. Reason A is not correct. This erroneously describes a present value calculation rather than a periodic mortality deduction. Reason B is not correct. This misstates timing and treats it as a single charge rather than a recurring mortality deduction. Reason C is not correct. This confuses cost of insurance with expense charging, which covers administrative loads. Question 16. How is interest credited to the accumulated value in a universal life insurance policy under current assumptions? A. Policy cash value is credited at the insurer's declared interest rate, subject to a guaranteed minimum specified in the policy. B. Cash value interest is credited based solely on the insurer's portfolio yield without any guaranteed floor. C. Interest credited equals the difference between gross premium and cost of insurance charges. D. Interest credits vary inversely with mortality risk, increasing as the insured reaches older ages. The correct answer is A. Universal life policies credit interest to the cash value at the insurer's declared rate, constrained by a minimum guaranteed rate outlined in the contract, ensuring a floor even if market rates fall. Reason B is not correct. This omits the guaranteed minimum rate that protects cash values when declared rates drop. Reason C is not correct. This confuses interest crediting with the calculation of net cash flows after insurance charges. Reason D is not correct. This incorrectly links interest credits to mortality risk rather than declared and guaranteed rates. Question 17. Which factor primarily creates the risk of policy lapse in a universal life policy due to underfunding? A. Failure to pay at least the target premium by the policy anniversary. B. Payment of an amount above the corridor requirement for the death benefit. C. Excessive funding beyond the target premium causing regulatory imbalance. D. Neglecting to fund the policy with the minimum required premium to cover cost of insurance and expenses. The correct answer is D. Underfunding risk arises when the insured does not pay the minimum required premium needed to cover mortality and expense deductions, leading to negative cash value and potential lapse. Reason A is not correct. This confuses the guideline target premium with the actual minimum payment needed to prevent lapse. Reason B is not correct. This misinterprets corridor requirement payment as a cause of underfunding lapse risk. Reason C is not correct. This incorrectly suggests that overfunding can create lapse risk, which is not the case. Question 18. A universal life policy includes an annual free withdrawal allowance of up to 10% of the beginning of year accumulation value and a surrender charge schedule that starts at 9% in policy year 1 and decreases by 1% each subsequent year until reaching 1% in policy year 9. In policy year 4, the accumulation value is $100,000 and the policy owner has already taken a free withdrawal of $7,000 earlier in the year. If the policy owner now surrenders the policy, what surrender charge amount will be deducted? A. $8,370. B. $6,000. C. $5,580. D. $4,650. The correct answer is C. This option is correct because the free withdrawal reduces the accumulation value to $93,000, and the surrender charge rate in policy year 4 is 6%. Applying 6% to $93,000 yields $5,580. Reason A is not correct. This distractor applies the 9% surrender charge rate from policy year 1 rather than the 6% rate for policy year 4. Reason B is not correct. This distractor incorrectly calculates 6% of the full $100,000 instead of the reduced accumulation value after the free withdrawal. Reason D is not correct. This distractor uses a 5% rate as if it were policy year 5 instead of the correct 6% for policy year 4. Question 19. In a life insurance contract, consideration refers to which of the following? A. The insurer's promise to pay the death benefit upon claim. B. The policy owner's payment of premiums in exchange for coverage. C. The agent's solicitation of the application. D. The beneficiary's receipt of the policy proceeds. The correct answer is B. The policy owner's payment of premiums is the value exchanged for the insurer's promise, fulfilling the consideration requirement in a contract. Reason A is not correct. Describes the insurer's obligation, not the consideration exchanged. Reason C is not correct. Identifies an agent activity, not a contractual exchange of value. Reason D is not correct. Refers to distribution of proceeds, which follows contract performance, not consideration. Question 20. Which feature best exemplifies the aleatory nature of a life insurance contract? A. Premiums paid and benefits fixed, regardless of claim occurrence. B. Unequal exchange of value contingent on an uncertain future event. C. Both parties' obligations become effective only at policy delivery. D. Policy terms are interpreted favorably to the insured when contested. The correct answer is B. An aleatory contract involves an exchange of unequal values dependent on an uncertain event, such as premiums paid versus potential benefits. Reason A is not correct. Describes a commutative contract where values are equal, not aleatory. Reason C is not correct. Refers to conditional receipt timing, not unequal value exchange. Reason D is not correct. Relates to adhesion doctrine, not the aleatory characteristic. Enjoyed this practice test? Tap like, hit subscribe, and share it with a classmate. Got a question we should tweak? Comment below, we read them all. Find full practice exam books in the description or at ExamPrep.School.